Hey, good morning, everyone. Welcome into Wealth Watch. Hope everybody is staying safe out there, and we're glad you took some time out of your day to join us. Probably be a little bit different format today than the previous few times we've gotten together. Joining me today is James Faraday, our Chief Investment Officer, familiar face from last week, and last week we tried to tackle a really broad topic when we talked about the broad market. And so an extension of that conversation today, we're going to discuss active management versus passive investing. And interestingly enough, this is a topic that could go probably 1,000 different ways and off on numerous different tangents. But for the purpose of today, what we're talking about is active portfolio management versus buying index funds. For the most part, we're gonna distill it down to that. So we're gonna jump right in this morning. And James, good morning. How you doing?
Good. Good morning. Thanks for having me. I'm surprised you had me back so soon after last week's episode.
Popular demand. Popular demand.
I don't know about that, but
the camera loves you.
I definitely don't know about that. But we thought active and passive management would be a good topic right now because we've been in this long period, really a decade-long, Clint, of a bull market where we haven't seen a recession since 2009. And during this period, we've seen really the rise of passive investments and passive investing over that period. So with a big pullback, with a big bear market like this that's led to, looks like it's at least leading to a recession for the economy, we thought it'd be a good time just to look at what are the differences there, how do we use active and passive management within our portfolios for our clients, and then just some of the pros and cons of both, because we definitely think there's a place for both in the marketplace out there.
So jumping into that, obviously there are, as I said at the outset, there are 100 different ways that you could characterize passive investment management. So maybe to jumping off, I don't know, we don't need to walk through what all of those are, but maybe hit on just some of the misconceptions people have when it comes to passive management.
Sure. So I think that the biggest misconception that's out there is that once you decide to go passive, there's no decisions around what you should select within that passive universe. So to me, there is an active decision-making tree, even if you go passive. So for clients or prospective clients that say, hey, I just want to go passive, I try to walk them through that active part of making those decisions, because even if you wanted to just put money into the large cap equity space, you still would have to decide what the underlying index would be to get that tracking right. You could use the S&P 500, which a lot of people know. You could use the Russell 1000. You could use the Dow Jones. You could use the MSCI World. So just from a starting point, there are some active decisions that would have to go into even deciding the index that you use. And each of those that I've just mentioned have different methodology in terms of how they put those indices together, and different methods of rebalancing those indices over time. So that's one of the biggest misperceptions that I've seen out there.
One, I think too, just as an extension of that, when you look at, just say, you're talking about, hey, we've got 2 or 3 different large cap indices that we could mirror. Let's say we're just using the S&P 500. There are even tracking errors within different firms trying to manage to that index, correct?
Correct. That's right. And usually those tracking errors are pretty small with an index like the S&P 500 because it's such a liquid market. You're talking about large cap securities. But when you look out at other asset categories out there where there's maybe not as much liquidity, you're going to have a much more difficult time replicating those indices. So high yields, one that, from an example standpoint, high yields, one that is very hard to replicate. There's not a lot of liquidity in that particular part of the bond market. And in some cases, there's just no volume of the underlying bonds within the index. So it's sometimes impossible to get a true representation of those underlying indices through the products out there.
I know too, you mentioned high yield, but staying in the fixed income space, obviously, if you're talking just high quality domestic fixed income, even there are some issues in terms of utilizing the index, correct?
So sorry, Clint, I couldn't hear you. Can you repeat that one?
Yeah, sure. Sticking in fixed income, even if we're talking about high quality domestic fixed income, you even run into issues there. Even though there's a lot of liquidity, there's plenty of issues that you're able to go out and purchase. You still run into problems there as the individual investor, correct?
No, absolutely. But, I mean, you still have a limit on the quantity. Typically in the equity markets, particularly the large cap space, you just don't have that limit on volume of the underlying securities, and the liquidity is there. But the fixed income, high yield particularly, there's liquidity challenges. But yes, even in the more investment grade space, there's a more limited quantity of those underlying bonds. So it is a challenge there.
And I think another area that we talk a lot about that people may not be entirely aware of is, they may be participating in a passive strategy and not know it. And some areas, just for example, where a personal investor or maybe a participant in a 401k may be achieving some sort of passive allocation and not know it, would be your allocation funds, your moderate, your low risk, your highly aggressive. The underlying funds in there are typically going to be index strategies, and where I see it the most is the target date funds within the retirement plan structures. So you may own the Vanguard 2040 target date fund, but talk a little bit about what that 2040 target date fund might be made up of.
Sure, and I think that's a great way to quickly get exposure to the markets, right? A low cost, quick way, an efficient way to drop money into the markets. We like those target date funds. We like some of the passively managed funds out there in that space. But I would say to clients that when you look at those, this active management in terms of the construction of those vehicles, so how they break down the cash, fixed income, and equities, there's a decision there that the underlying fund manager makes. So those active decisions on the asset class level, then you break it down further. How much should I have in large cap, mid, small cap, international, REITs? Same thing on fixed.
Do you need to get that?
No, but I'll put it down so we get the ringing stuff. I thought everybody knew I was working from home today, but so there's those active decisions that those passive managers actually have to make, even on a target date fund. And then I think a more important question on those target date funds: when do we pare back the risk? At what point do you start trimming back the equity exposure? At what point do you add another asset category? Because there have been times when those target date funds have had to make the decision. Should we now include international fixed income? We didn't 5 years ago, but now it's such a big part of the world investable market out there. We want to include that. So there's a lot of different, again, a lot of active decisions along the way, even in a passive vehicle.
And I think our takeaway there for those of you joining us is, in the case of an allocation fund or a target date fund, we like those a lot. We endorse those structures because for a participant in a 401k plan, they're probably not armed with the knowledge to go out and build an allocation for themselves. And I'm speaking generally here. I'm not speaking about every participant, but giving them a tool that provides them with a best guess asset allocation is certainly valuable, even though you might miss one asset class or it may not be weighted specifically to their risk tolerance. So I certainly don't want anybody to walk away thinking that we're not a fan of target date funds or a fan of some of these structures. It's just making sure that they're used in the right context.
No, absolutely, and that's evolved in. If you look at the 401k industry, the retirement industry, when 401ks first started, the default option often was cash, right? Over time, that moved to a balanced fund with a static asset allocation. Then it moved to risk-based funds, and then target date funds, which I think those target date funds are a great way, even if you're using passive investments underneath them, great way to quickly, like I say, just get a quick allocation and not have to do much along the way. Because that's what most investors, they don't want to have to worry about the rebalancing. They don't want to have to worry about the decision of how much in each asset class do I need to put my money. So great, yeah, great fit there.
So James, I wanted we actually got a question before we got going this morning, and I wanted to give you a little time to get warmed up before I threw it at you. But
okay.
There is a question: is there some way to hedge against a complete collapse, long-term collapse of the economy?
Ooh, that's a tough one. I think my quick response to that would be there's definitely some more conservative sectors out there that would do better in that scenario, and I think it would take a number of years, perhaps decades, for that to occur. So it'd be very hard to kind of time those hedges, and you could be losing a lot in between as you try to hedge out that risk over time. But I don't think there's probably some hedge funds out there that have, that type of scenario embedded in, but to time that I think would be very difficult. The other way, of course, would be going long gold guns and potentially Bitcoin. I guess here would be the latest investment that you can use. But that would be, if the economy did have a long-term collapse, I think there would be other issues out there, right? You could, I guess, invest in government bonds, and at some point, if the government was failing, then there would be bigger issues for all of us.
Yeah, your off-the-grid life would be way more pressing than your economic standing, I suppose.
But that's a tough one. We do try to hedge out a lot of risks over time. If you look at our portfolios, we talked about this last week, but we don't just build out equity portfolios in the large cap space. We have balanced portfolios. We include different asset classes to try hedge out some of those risks to give our clients a more consistent return over time. And that's certainly helpful when you look at this bear market. If you had no cash, no fixed income, you took the brunt of that on the nose. And kind of circling back to index funds and passive investments, for certain you will take the full brunt of the downside if you're holding an equity passive fund in a bear market. Active managers at least have the ability to hold a little bit of cash, hold a little bit of fixed income, maybe pull back on some of those sectors that are going to be hit harder than others. You can't necessarily time being out of airlines and hotels and tourism, but as a firm, for example, those were areas that we avoided just from a discipline standpoint. But we're not going to be investing in those areas anytime soon on a large scale. And
I think you're as you're starting to speak to that, I think you're starting to speak to what I think the overall thesis of what we wanted to talk about today was, which is maybe not this direct, but what is our thesis statement? Which do we prefer? Do we prefer active management? Do we prefer passive vehicles? What's our go forward?
Sure. So we are active managers at our core. But we use a blend of both active and passive managers within our portfolios. We still think there's being able to quickly enter a particular asset class or asset category at a low cost and an efficient way. Passive vehicles are a great way to go. But we also know that there's certain asset categories where it is active managers have a leg up versus the passive vehicles out there. We talked about some of those indices that are hard to replicate, like high yield. I would also point to an asset category like the emerging markets, where if you look at how the emerging markets indices are built, those economies are right now anyway, those economies are very much commodity focused, material focused, and industrial focused. That's not necessarily where I want to be invested in the emerging markets. I want access to the consumer. So an active manager gives me the ability to be more orientated towards that part of the market than I would want to be allocated towards.
Hey James, I'm gonna pull up the slide that you and I were looking at when we were entering into this discussion, the active manager outperformance.
Sure.
And I think, and I don't know if you want to talk through this or we just want to leave it up on the screen for a second as a visual, but I think this nicely illustrates the point you're making about the asset classes where we do want to use index product and maybe we want to go more heavily into index product versus the ones where we really have no interest in using a passive strategy at all.
Right. Well, and this kind of Clint, are you back?
Yeah, I'm back. I don't know what happened there.
Okay, sorry about that. We kind of dropped off. So we've got that chart back up, but one of the misconceptions is that passive always outperforms active, and that, you know, this is looking at a period and just showing that over 50% of the asset categories out there, actually active managers are outperforming the passive vehicle funds. What the media tends to focus on, and it's highlighted here on this slide, is that large cap blend space. So that's that S&P 500 space. It's the space we're all most familiar with, right, in that terms. But this is why we don't necessarily just put money in those passive funds. We're going to look at different categories and say, you know, historically, active managers have been able to add some value in those spaces.
So,
and even it, go ahead. Oh, I was just going to say, even if you look at the large cap blend space, there are cycles over time. I think we have another slide out there that kind of shows the cycles that active versus passive has gone through over time. So what we're looking at here, for those of you watching, is the green line is passive investing, the blue line is actively managed. This is in the large cap blend space. So that again, that area that the media really focuses on. This goes back to 1985 through 2017. And what you'll notice is there's different periods where the active does better than the passive and vice versa. The last 10 years, and you can add on 2019 to that, active has underperformed the passive side of the equation. But if you look at the decade before that, it was a total reversal. So coming out of the dot-com crash, active managers added a lot of value through decisions. So as the other thing we look at is as correlations decline, and not to get too technical, all that means is as stocks are moving in more different directions, they're really being rewarded for how they're managed, how their growth profile looks, what their balance sheet looks like. That's where active managers tend to have the edge over the passive cycle. So when I say we use a combination of both, we think that can give us a more consistent return over time for our clients, and not just a one-stop serves all type of scenario. So we just don't believe that. The other factor, Clint, that I would bring into why we don't just use one or the other is that a lot of our clients have very specific objectives that they're trying to that they're trying to get out of their investments. So, for example, a lot of our clients want a high level of cash flow, dividend yields coming off their portfolio. That's not necessarily something you can get with a passive investment. A lot of our clients also have tax considerations, right? So you look at from a this is particularly on the personal side. They want to try to reduce their taxes as much as possible, keep capital gains as low as possible. That becomes very hard with a passive vehicle. Some active overlay, some active management on top of that can really help to reduce their taxes. We have clients who have very specific liabilities that they want to match up to, or legal constraints or risk constraints out there from a corporate
or
standpoint.
Even social restrictions.
Yeah, social restrictions is a great one. So again, passive. There might be some passive vehicles out there that get you somehow there, but you need that active overlay to make those decisions for a more customized objective for those type of clients.
So we've talked a lot about misconceptions or maybe mistakes that are made with passive products, and as we start to bring it to a close here, and I'll say that as a reminder to those watching, if you do want to submit any questions, now would be a good time. But as we bring it to a close here, talk about, and maybe specifically to WealthSouth, but talk about where we think passive strategies are appropriately deployed. I know you've touched on that throughout, but I don't want people to walk away with the notion that, hey, because we're active managers, we don't believe in passive products at all. So talk about how we deploy those within our own portfolios successfully. James? Okay, it looks like we may have lost James. Hold on just a second. Sorry for the technical difficulties here. All right, well, looks like James, we've lost James for a minute. I do know, just in discussions with James previously, that obviously passive products that we do use in our portfolios, they achieve a couple of different aims. One, they do give us broad exposure to different asset classes at a low cost, and obviously that's one of the strengths of passive strategies, is that low cost. The ability to be able to buy the broad market, but not have all of the execution costs, not have any overwrought underlying expense ratio, and for us, that's one of the key drivers. The other is, and James used the example at the outset, we don't buy all equities for clients. We have a blend of equities and fixed because we don't know necessarily when one is going to be in favor over another. Otherwise, we'd all just be invested in equities year round. Well, same token as the cyclical chart that James referenced earlier showed, there are times that active management is in favor and is outperforming, and there are times that passive management is in favor and it's the lead. So we want to have a nice blend within asset classes where it makes sense, so that we're not missing out on those cycles. It does not look like I'm going to get James back, so at this point we're gonna come to a bit of an abrupt end. Thank you for attending, as always. We look forward to seeing you next Wednesday at 10 a.m. And until then, stay safe and take care.